All right, so we are looking at self-constructed assets, okay? When we have this construction period, and if we have a construction loan, we are talking about capitalizing interest from that construction loan into the actual asset, okay? Remember the definition, bring anything to bring it to its intended purpose is what gets added into the asset. So that's their justification on capitalizing the interest. Okay. So it does have to be qualifying assets. There has to be a period of capitalization and there has to be the amount. Okay. Only a portion of the interest, not all of the interest will be capitalized. Okay. So there is a lot to unpack in just this one slide right here. So if you wanted to pause the video, grab that, or if you have the PowerPoint open, it'll be that slide 68. Okay, there's a lot of things going on here. Okay, and I decided to do this in Excel. Okay, so let's see. The first part, I know there's a lot of stuff here. Ignore as much as you can. We're going to start right here. Okay. This information was given us. So this is weighted average accumulated expenditures. Okay. I'm going to cut my screen in half so you can see both of them for right now. So you can see right there on January 1st, 500,000 was spent. Okay. Then on March the 31st, another 400,000 was spent. And then on September the 30th was 600,000. Okay. These dates are very, very important to us. Okay. Because what we're trying to find is the weighted average accumulated expenditures. We know how much money we spent. Sorry, we spent 1.5 million. Okay. So this 500,000 is going to be outstanding for the whole year from January 1st all the way to December 31st. So I don't know if you know you can do this. You can put an equal sign into Excel and then you can type your fraction in and it'll automatically divide it for you. So when I did this by hand, I actually did the fraction 12 by 12. Okay. 100%. Okay. So then let's look at the next one. So it was outstanding from April all the way to December. Okay. So that should be a 9 divided by 12. Okay. 9 divided by 12. So it's 9 months. All right. So we're going to hit our equal sign and hit 9 divided by 12. Okay. And then we get down to September. So it's September, October, November, December. Sorry. I think I might have typed that in wrong. I did. I put the 3rd, not the 30th. I was looking at my cheat sheet and I was like, that's not right. So that should be 3 out of 12. So we'll hit the equal sign and hit 3 divided by 12. Okay. So I'm going to put those all in percentages. Let me highlight them all. That's how you do this. You can put it in percentages and it looks nice and pretty then. Okay. But when I did it by hand, you can see right there, I just kept the fractions because I was putting it in my calculator. All right. So we can't really like show the fractions in Excel. And if you can, I don't know how. Okay. So now that you know where all that come from, we're going to take each one of these. I'm going to take that number and multiply it times the 100%. Yes, we know it's going to be 500,000. Okay. I have some automatic formulas that are going to populate as we go. Okay. I want each one of these to go across so I can just drag and drop that formula all the way down. And I know it's right because I did calculate 950,000. Okay. So that problem, they went on to tell us that they had noticed that the capitalization period is January 1 of 27 through June 30th of 28. So that's a little tricky when we do 28. We're only going to do 6 months, so our fractions will be by 6, not by 12. Okay. So they had some debt. So they had $1 million construction loan that they took out with 8%. That's specific to this project. Okay. So, but they had other loans outstanding during the entire construction period. The company's other interest-bearing debt was $2 million at 6%, 4 million at 12%. Well, I've already plugged those into right here. I'm going to delete them just because. So that's that specific debt right there. Okay. Then here's the other two debts. Okay. So I want to do the same. I want to multiply those out. This was for a whole year, so I don't have to do a fraction on this one. Okay. So I'm going to take that 1 million, multiply it times 8%. That's how much interest I have right there. And then I'm going to come down here and drag and drop all of those. So our actual total of interest is 600. Let's see, the Excel spreadsheet says down here. So I think it's 680. Let's just do a total real quick so we can see that. Okay. $680,000. Okay. So right here is a formula for our average debt. We're going to need that in a few minutes, but we're going to go ahead and do it right now. Okay. What they're talking about here is taking the debt they had, these two right here, and getting an average. Okay. How are we going to do that? Well, we're going to add up these two numbers. That's the total interest. And then we'll divide it by the total principal. Now we can write a formula. So, oops, we can do equal, and I just do parentheses and take that one and then add the other interest together. And then, oops, I'm going to divide that by these two added together. Okay. And it should be 10%. Okay. So I will put that in percentage format. So that gives us 10%. Okay. We always have to pick the lesser of the two. Okay. So specific calculated debt, they had a weighted average accumulated expenditures $950. We cannot use the 1.5 million because 1.5 million was not outstanding the entire year. This million times 8%, that's a whole year's worth of interest, but we didn't do that 1.5 million for the entire year. All right. So the specific calculated debt is lower than the actual debt. So we're going to pick the one that is lower. I think I might be able to write on here. There we go. So we're going to pick the lower one. Okay. So then we come down here at the end of this 2027 and we're going to capitalize $76,000 of interest. So we're going to take that, and I think I wrote a formula to add the 1.5 million to the 76,000. Okay, but you're like, whoa, wait a minute, you didn't use that number. Okay, 1.5 million is what we have outstanding at the end of the year. Okay, the 950,000 is just that weighted average of all these strings of cash flows. Okay, like if you just took these first two, so like up until September, they only had like 800,000 outstanding. Okay, so you're not going to get to capitalize more interest than what that weighted average accumulated expenditures gives you. Okay, so that is all for 2027. Okay, I'll jump back over here. So they give us 2028 numbers as well. They did not give us a January 1 because January 1 we just calculated. It was the 1.5 million plus the 76,000. Okay, so we had these strings of cash flows on, move it over a little bit. There we go. So we had on January 1st, the 1.5 million plus the 76, we had that. It was outstanding the entire time. But remember, this is only 6 months because the project is done in June. Okay, so we will take the fraction of 6 divided by 6, which should be 1. Okay, then we're going to take the from January 31st to June 30th. That will be 5 months. Okay, so we will hit equal 5 divided by 6. Okay, then March, we have May and June. We only have 2 months left. We'll hit equal and take that 2 divided by 6. Okay, we're going to do the same thing that we did earlier. We're going to multiply those out. Okay, and we're going to do that for all of them. I'm going to drag and drop, and I'm going to go ahead and do that one. Nope, not do that one. So let's total that up. There we go. Okay, so 2176 is our weighted average accumulated expenditures. Okay, I have the calculated debt there, but I'm going to just grab this actual debt over here and bring it over because we're still using it. It's just over there already calculated. Okay. Let's put a little line there. Okay. So we've already calculated that. It's the exact same average debt as we had previous because they didn't tell us that none of the debt changed going into the next year. Okay. So we had this 1 million that was specific to the debt. We have to get this number to the 2176. Okay. Basically, this number is equal to this number, and I backed into the 1.1. Okay. So I'm going to take the 1 million, multiply it times 8%, and then multiply it times 1/2 because remember, this is 2028. This project is done in June, so we cannot take interest that's going to be done afterwards. Okay. And technically, all of these would be halved. Um, Let me do that really quick because it might really not make sense with taking the it's equal to 0.5 times that. Now you're going to see. All right. So there we go. There we go. All right. So the actual debt for half of the year is going to be the 340,000. Okay. Remember we did that 10%. So that first specific debt, we've got that. We're going to use that one first, and that'll be 40,000. And then we came over here and calculated the average between these two debts right here. Okay. We basically just averaged them together because they obviously they had more debt than they didn't take out the specific amount of debt for what this project was, but they had other debt. So we're assuming part of that other debt went for this loan as well. Okay. So we're using this number to get our amount of interest. So you can see 98,800 is smaller than 340,000. Okay. So we will capitalize 98,800, and I wrote a formula for this one right here. I took and added, let me highlight it, the total amount that they spent on the project and the 98,800. And that will be their capitalized amount at the end of the project. So just kind of watch the questions because they may say, what was the capitalized interest or what was the project's capitalization at the end? So just be careful when they're asking you questions. Okay. So that was a lot. That took up a lot of time, but it went through all of these. Oops. Okay. That was where I worked it by hand. We don't want to work it by hand again. So all of this was done throughout several of these slides. So we are going to kind of skip through them. We got all the same numbers. Yay. Okay. Um, all right. So here they give you a disclosure, kind of showing you where Johnson & Johnson actually capitalized interest and how much they capitalized. Look, they capitalized a lot of interest. Okay. Um, so that was quite a bit. Okay. I'll hover there for a quick second. In case you want to pause the video and do that one, you can. All right, so let's talk about overhead allocation. Okay, overhead allocation, this is where they might be using, and I always use the example of a handyman. He's probably got a little trailer behind him, or somebody who's mowing yards and they've got a utility trailer behind them. They have lawnmowers, they have weed eaters, and they have string. Those are all overhead because they use those for every single job, and how they apply that overhead is very, very important. Okay. So keep that in mind. Research and development is always expensed as it is incurred. Okay. Expensed as incurred. I'm trying to see where I'm at here. Okay. And IFRS can be just a little bit different when it comes to research and development. Okay. So come down here, I'll tell you what, we're going to stop the video here and I will make another video finishing this up.